Welcome back to the deep dive. So we're starting this session with a really fascinating question, I think. How does a massive industrial company deliver what they call record-setting performance while also saying they're navigating a dynamic macro environment?
It's the classic balancing act, isn't it? And Nordson Corporation, that's NDSN, they seem to have pulled it off in their 2025 fiscal year. The story here isn't really about massive top-line growth. It's much more about sharp execution, smart portfolio changes, and just incredible discipline where they could control things.
Exactly. And that's our mission today. We're going to unpack their fiscal year 2025 results. We're working from a press release that dropped on December 10th and the investor slides from the 11th. We want to get past the headlines and see how they actually hit their goals, what they did with this huge pile of cash, and, where they're looking for growth in 2026.
And we have to start with that big headline number for you. For the full fiscal year 2025, Nordson posted record sales of $2.8 billion. And, maybe more importantly, they finally hit that big goal from their Ascend strategy. They reached $900 million in adjusted EBITDA.
Hitting a number like that in 9 figures, that's a huge milestone. Okay, so let's unpack that. Section 1, what really allowed them to call 2025 a strong year when, the global economy was clearly squeezing their big industrial customers?
Well, the strength really came from their margins and their strategic M&A. Let's just run through the key metrics for the year ending October 31st. You've got the $2.8 billion in record sales, which is a 4% increase year over year, and their adjusted EPS also hit a new record. $10.24. That's up 5%.
And getting that kind of EPS growth when things are tough, that's pretty impressive.
It is. And back to that EBITDA number for a second. They hit the $900 million, and that kept their overall EBITDA margin incredibly steady at 32%. But what's really telling about their operations is the gross margin. It stayed at a super robust 55%.
55%, wow.
Yeah, and they did this despite what they called an evolving tariff environment, which, that just screams world-class cost control.
Okay, but a 4% sales growth. It's solid, but it's not huge. And if we dig into the components of that, the sales bridge, that 4% number is hiding a pretty big story, right? What was the organic part of that?
This is where you see the strategy at work. That 4% growth was almost entirely driven by a 6% tailwind from their acquisitions and divestitures, mostly the Atrion medical integration. So if you strip out all that M&A activity, their underlying organic sales actually went down by 3% for the year.
A 3% organic decline. So that's the real focus here. They basically use smart acquisitions to paper over some cyclical weakness. But for you listening, that raises a flag, doesn't it? Is the core business actually healthy, or are they just buying their growth?
That is the multi-billion-dollar question. I mean, they're running the playbook perfectly, using these high-growth medical acquisitions to power through a slump. But a 3% decline is not nothing. And it came from 2 very specific places: major weakness in polymer processing systems and in the automotive markets.
So the success of 2025 really hinged on that strategic framework they talk about.
Absolutely.
We hear phrases like Ascend strategy, NBS next growth framework, owner mindset. For someone who doesn't read these reports every day, what does that actually mean? How does that lead to defending a 55% gross margin?
It's all about decentralizing responsibility. The owner mindset, for example, basically puts P&L responsibility right down at the product line level. It makes every little unit act like its own business. And the NBS Next framework, that's just their continuous improvement system. The fact that gross margin held up while organic sales were falling, that's the proof it's working. They're not just waiting for the market to get better.
And the Atrion medical deal was the big piece of that puzzle.
Oh, absolutely. The Atrion integration was a home run. They folded it in. It started contributing to sales and EPS right away in its first year. It shows they know how to not just buy companies, but actually integrate them and get value out of them fast.
That's a crucial point. Okay, let's pivot to section 2, because if your organic sales are soft, you absolutely need to have rock-solid cash flow. Let's see how they used it.
And their cash performance was, frankly, remarkable. Fiscal year 2025, they set a new company record for free cash flow. It's $661 million, but the really impressive number is the conversion rate. It was a record 136% of net income.
136%. That's an incredible number. Just to spell that out for you, what that means is for every single dollar of profit they reported, they turned it into $1.36 of actual spendable cash. That just signals incredible efficiency.
Exactly. So they took that $661 million and used what they call a balanced capital allocation approach. It went to 3 main places. First, they bought back a lot of stock, about $306 million worth. Second, they really focused on paying down debt, about $224 million. And third, They kept paying a dividend, which was $179 million.
So they weren't just spending, they were deliberately deleveraging the company, making it stronger.
That's the key. All that debt paydown brought their net debt leverage ratio down to 2.1x. So to put that in context, that means they could pay off all their net debt with just over 2 years of their current EBITDA. That puts them at the low end of their target range, and it basically gives them a huge war chest for the next acquisition.
Right, that gives them a lot of flexibility. Okay, so now let's drill down into the segments because the full year numbers can hide what's happening right now. The fourth quarter sales were $752 million, up just 1%. How did the three different parts of the business look in Q4?
Yeah, the Q4 data really shows where the pressure points are. Let's start with Industrial Precision Solutions, or IPS. That's their biggest segment, and it's where most of the organic pain is. Q4 sales, there were $362 million, down 2% overall. Organically, sales dropped 4%.
So that 4% drop confirms that the industrial weakness carried right through to the end of the year. Was it still that polymer processing business?
It was. That's where they saw the biggest declines. But, and this is the important part for IPS, they defended their margins like crazy. Even with lower sales, they posted EBITDA of $137 million. That's a 38% margin for the quarter, which is actually up a little bit year over year.
Wow. Holding a 38% margin when your sales are shrinking, that really speaks to that operational control we were talking about.
It really does. Okay, so now let's talk about the star of the show, Medical and Fluid Solutions, or MFS. This is the segment that's driving their whole inorganic strategy.
Right.
MFS was the anchor, no doubt about it. Sales hit $220 million, which is a big 10% increase. And crucially, their organic sales were up a really strong 7%. That was just broad-based demand across the board.
And this is where the M&A really paid off, but didn't they also sell something in this segment?
That's right. The sales got a big boost from the Atrion acquisition, but that was partly offset because they sold off their lower-margin medical contract manufacturing business in September. But the real headline here is the margin. MFS delivered $88 million in EBITDA. That's a 40% margin.
A 40% margin, and that was up how much?
Up 380 basis points year over year. That's a 3.8% jump.
Right.
It's now their highest margin segment, and it just proves their strategy of shifting into these specialized medical areas is working.
Absolutely. Okay, finally, let's look at Advanced Technology Solutions, ATS. How did the high-tech part of the business do?
ATS is always a bit more volatile. They reported $171 million in sales, which was a 4% decrease. That was driven by a 5% organic drop. It's a mixed bag. They saw some real strength in electronics dispense systems that's tied to AI and advanced packaging. But that was wiped out by tough comparisons and weakness in their test and inspection systems.
And the margins there, that kind of mixed performance must have had an impact.
It did. EBITDA for ATS was $43 million, so a 25% margin. That was down about 200 basis points from the year before. And that drop was really from two things: lower sales volume and an unfavorable product mix. They just shipped more of the lower margin stuff in the quarter.
Okay, so that paints the full picture for 2025. Smart strategy and great cash flow covering up some real industrial softness. Let's pivot now to Section 4 and look ahead. What's the basis for their optimism? I mean, they're explicitly calling for a return to organic growth in 2026.
Well, the foundation for that starts with their backlog. It's sitting at about $600 million, and that's up 5% year over year, even after you exclude the business they sold. So that provides a nice cushion. But the real drivers are some specific shifts they see happening in their end markets.
Okay, so let's get into those. Where exactly do they see growth coming from next year?
For MFS, the medical segment, they're expecting supply chains to normalize, which should help their interventional products. But the bigger trend is demographics. An aging population means more medical procedures, and that's just a long-term sustainable tailwind for their surgical and interventional tools.
Right. And what about ATS, the tech segment that had a bumpy Q4?
For ATS, they are all in on the biggest trend out there, AI. They say AI is driving huge demand in advanced packaging, which needs the super precise equipment they make for tiny, complex chips. They also think the automotive electronics market is going to stabilize, which gives them a solid floor.
So high-tech is expected to pull that whole segment up, but what about IPS, the industrial segment that was the source of all the pain? Are they expecting a big comeback there?
Not a big comeback, no. They're only forecasting what they call a nominal recovery in polymer processing and automotive. The growth drivers they're really counting on there are things like packaging and product assembly and continued strength in precision agriculture. Basically, they're counting on the aftermarket to keep margins high while they wait for the cycle to really turn.
So stability in IPS and high growth from MFS and ATS, what does that all add up to for their official 2026 guidance?
So for the full year, they're guiding for sales between 2,830 and $2,950 million. That's about 1% to 6% total growth. But importantly, after you factor in some currency effects in the divestiture, that guidance implies they are definitely forecasting a return to positive organic growth.
And on the bottom line for earnings.
Adjusted EPS is forecast to be in the range of $10.80 to $11.50. So that's a pretty healthy 6% to 12% growth over this year's record. They also gave some Q1 guidance, which is usually their weakest quarter, so they show some transparency.
It sounds like hitting that 2025 goal just set them up for an even more aggressive long-term plan.
That's exactly it. The sources make it clear they've set new long-term targets out to 2029, 6% to 8% average annual revenue growth, and an even more ambitious 10% to 12% adjusted EPS growth. They've proven they can manage for margin. Now they have to prove they can generate consistent organic growth too.
This deep dive really gives you a clear look at Nordson's 2025. It's a perfect case study of a management team using a smart portfolio strategy to beat weakness in their traditional markets.
Absolutely. The main takeaway here is that even with that organic softness, they hit that big $900 million EBITDA target. They did it by using strategic acquisitions like Atrion and by being incredibly efficient at turning profit into cash. I mean, that record $661 million in free cash flow, that's a real story.
That agility is definitely key. But here's a final thought for you to chew on. Nordson has set this very ambitious goal, 10-12% adjusted EPS growth every year through 2029. Now, to do that, they have to stabilize their slow, cyclical industrial markets while also capitalizing on these fast-moving, sometimes volatile tech and medical sectors. So which of these is going to be the more reliable driver for that double-digit growth over the next 4 years? The steady industrial base or the high-tech, high-margin growth engines? We'll leave you there.